Do others on the panel feel that, your communication with clients has changed and similarly as what sort of Steve described and having to, talk about why, in his case, process shouldn't change and why he believes that, but how has communication changed with your clients after, in response to what we've gone through over the last 18 months, or if at all? Yeah, Bob.
Well, the big one is everyone went out and denied any relationship to Madoff. And we all had to make sure every investor knew that we had a prime brokerage relationship, who our accountants were, and basically distanced ourselves from all the mistakes that the investors found themselves in with the Madoff world. We're a SEC registered advisor, so this mandatory registration doesn't mean anything to us, because we've already dealt with it 25 years ago. But I think one of the big things that we find is that the PMs and the Kayne Anderson top guys are spending a lot more time on the road talking to people. Sales force are very, very powerful. Like most of our sales force are ex-investors. They're very talented people. But at the end of the day, the investors want to know what happened in the portfolio so that they can often relate it to somebody else. When you have a lot of 110 university endowments, they all have chief investment officers that they're going to have to tell the chief investment officer what was going on in the strategy they invested in. And so they want to be talking to the PMs. They want to be talking to us. The sales force is probably on the road 50% more than they were before. The emails and the telephone calls are not handling what used to be handled. But you get out there and you tell them, and most people understand what happened. They just fear the unknown. So as much communication as possible is very, very important. And then finally, all your investors are not alike. We had investors say, slow down in your oil and gas investing because I'm not sure I can meet a call. And other people said, I hope you're not slowing down in your oil and gas investment because this is the greatest opportunity we've ever had. So we've had to deal with those issues too.
Others, how are you guys managing your sort of clients' communication expectations?
I think that the sales cycle has lengthened. I think people are much more cautious. I mentioned that there's this sort of bigness effect where people want to go to the tried and true name. The concern about auditors, who your auditors, who your prime brokers are, who your administrators are, is really important. It's taken, when we gave money back in the distress space in 2006, I thought, okay, well, distress will reappear and then we'll be able to raise money again. And we started about a year ago, and it's taken me almost 12 months to get to 100 million. And that was surprising to me, and how long it took and how difficult it was to start from a standing start.
How much did you get back?
About 350 million.
Troy or Stephen, any?
Yeah, we've seen the granularity of investor questions increase, and it seems that in general, investors, I think, ask more pointed questions now, post-08. So there was this period of time where I think, as a whole, the consultant community, institutional investors, they were to some degree playing catch-up. So we would find questions coming in over the transom in a reactive manner. Do you have Madoff exposure? Do you have Petter's exposure? Bear Stearns is going away. What's your exposure to Bear? Now we find that the questions are more proactive. Are you multi-primed? How do you manage your derivatives? What's your process around managing your exposure to any one counterparty? So I think that the last 18, 24 months has been a shaping experience for the investors, in that they have been forced to understand a bit more than they used to care to understand about the industry and the way hedge funds work.
There's another big issue out there, and there's a partnership of limited partnerships being formed, or at least having more power, and they're trying to institute some discipline in how people price their products. If you were a private equity guy and you were leveraging your investments at 80% and you only had to grow the equity of 20%, a 5% growth rate got you a 25% rate of return. If you are a private equity guy now and you can only leverage your thing 50%, that 5% growth rate is only a 10% growth. And so you've got a 2 and 20 financing structure and you're only delivering 10 or 12%. Well, that's probably not going to work for very much longer. And so everybody's starting to talk about pricing things differently, as it should be priced depending on the value created, the height of the return. I mean, to do a 2 and 20 on a 10% return is a lot different than a 2 and 20 on a 30% return. You can actually find yourself in the quandary of your carry eating up the entire alpha that you've created, and that you get an index out there doing something and you're trying to put a 20% carry on your alpha and your alpha gets wiped out, and so now you're back to the index. And so what value have you created? So there's a lot of issues on pricing out there. There's a lot of issues in the private equity world on who takes fees. Kayne Anderson, any fee you earn goes to the limited partnership, whatever the fund you're managing. A lot of people split it. The GPs take 50% of the return, sometimes 100% of the return. And I have yet to find somebody who can rationally explain to me why a general partner is out there sitting doing an M&A deal for one of his portfolio names and is personally taking the investment banking fee. That's what the management fee is supposed to be paying the guy for. So, there's a lot of issues out there on pricing. I would say that the average expectation of a return, if you aren't manufacturing it synthetically with leverage, has gone down and should have gone down in this market. You probably should be very, very happy to have a 12% return. I personally, if somebody could tell me I could take my entire net worth and put it in a 12% return and walk away, it's a pretty exciting thing to do. So I think we're going to find repricing of everything and a differentiation of pricing depending on what the value created by the management company is versus what the value created by the product is. Product meaning the industry or the beta of the industry.
Others care to comment on, are you guys feeling the pressure from investors? Are they questioning the fees? Or, Steve, I'm curious sort of from your, as the quant on the panel, how are those conversations going, or are those questions coming up?
I don't think we've seen it so much on the fee side. In terms of the original question of just what are you doing differently with clients, I think it's basically just staying in front of clients as much as possible, being on the phone and traveling to meet with clients and consultants. I mean, one thing that we try to do to sort of, it's a very competitive business. Whether you're a fundamental or a quant, we all know this is a very competitive business. And we always try and find something new in terms of research, maybe publish a paper, or maybe just a small kernel of an idea that that we can talk about and present to clients and present to prospects and present to consultants. And those little things, I think, go a long way. I mean, all of our strategies have cycles, and there's going to be times of outperformance and times of underperformance. And I think the key is in times of underperformance that you stay in front of clients, and anytime you can give them something sort of unique to think about, and when you leave the meeting, that they remember, they take that with them, I think is critical. And so that's something that we always do, and we're trying to do more of in terms of just staying in front of people, giving them something unique that they can take away with them from a meeting.
Others on either point or on the...
I've noticed post Madoff, there's a lot more interest in separate accounts, and larger institutions are able to demand and receive separate accounts, particularly when they're dealing with smaller firms. And so that's a big change. It's not costless for the institution because then there's more documentation requirements. They have their own auditing costs, but it also gives them control and transparency that they might not have in a fund. We've always been fairly transparent with our investors, but it's different when you actually have title to the assets, and that's one of the changes that's evolved, I think, post-crisis as well, is that sort of demand for ownership.
That came out of not only Madoff, but also the gating.
Yeah, right.
Somebody has his own account, he
Right.
can't get gated.
Yeah, that was a large part, investors feeling abused by managers, unfairly abused.
How are you fairly abused? No, I'm kidding.
That's a good question, Bob.
Troy, from your perspective, or how do you feel about the fee and carry model?
We haven't seen any real tangible manifestation of a call for a new model from the folks we speak with. Now, I think there's some compelling thought pieces out there. The Casey Quirk piece comes to mind about better aligning investor interest with interests of the management company, and all that sounds good. I think it's going to ultimately, if it does come to fruition, it'll be a CalPERS or it'll be one of the very large alternative investors forcing the model, because I don't think anyone's going to volunteer to move away from the 2 and 20.
I admire Steve. Steve made a comment that, would we all have the integrity to do what he did, which is he thought his product was out of favor and he returned the money. I think that's a huge issue for PMs, because I assume your income went down when you had no money to manage.
That's a good assumption.
And now he's got an ideal time to invest in his strategy. I mean, if any of you have any extra money, give it to him. It's an incredible time right now. And yet he can't raise the money in anything like what he gave back. And it's that terrible lag that happens where, I'll tell you, I can raise all the money in the world at $140 oil. I can't raise a lot of money at $50 oil.
Well,
I'd rather obviously have the money in $50 oil.
It's my sort of takeaway is that when it's easy to raise money, it's probably not a very good time to invest. And when it's a very good time to invest, it's much harder to raise money. So that just means you're on the road more and you're spending more time at it. But it definitely, the boom times when money's flying in the door, that's when the red light should be flashing. And it's kind of an irony of this business, I think.
That reminds me of the old George Carlin story. Female bumblebees buzz and male bumblebees bite or sting. So if you hear a bumblebee, don't worry. I mean, if you're willing to invest in a company, don't invest. If you're not willing to invest in a company, then do invest. It's a hard argument.